By the start of 2001, Enron was the titan of American energy. They controlled the national power grid and dictated market terms. Wall Street adored them. For 6 years straight, Fortune magazine named Enron America's most innovative company. Their momentum seemed unstoppable. The men behind the glass, like Chairman Kenneth Lay, were hailed as the smartest guys in the room. They were the architects of a new era of American finance. But there was a massive disconnect. While their value was $60 billion, the company's actual cash flow was drying up. Enron had created a massive gap between what they reported and what they owned. This was a system designed to manufacture wealth on paper while the bank account sat empty. The engine of this growth was a specific accounting method pushed by executive Jeffrey Skilling, mark-to-market. The strategy was simple. When Enron signed a contract, they recorded projected profits for the next 20 years as immediate income. Even if the deal fell apart later and cost millions, those imaginary profits stayed. The ledger stayed green while the business failed. It functioned as a mask for the company's true health. Enron reported record revenue to regulators, while actual operations failed to generate cash. As the fake profits grew, so did Enron's actual debt. They borrowed billions to keep the lights on, and that debt threatened to destroy their stock. To keep the books clean, they offloaded their liabilities into a web of shell companies. These entities acted as dumping grounds for Enron's losses, keeping the debt hidden from investors. To the outside world, Enron was a powerhouse. Internally, executives knew the debt was unmanageable. They were standing on a house of cards. While telling the public the company had never been stronger, the insiders began cashing out. They sold their personal shares for millions before the truth could reach the market. This wasn't just bad luck. It was a calculated exit strategy for the leadership, executed at the expense of everyone else. In late 2001, the hidden debts came to light. The stock price vaporized, and Enron filed for the largest bankruptcy in American history. The executives walked away with millions. Their wealth was secured long before the company collapsed. This chart shows the stock's final descent. As the price crashed toward zero, Enron froze the retirement accounts of its workforce, barring employees from selling their shares. Hard-working Americans watched decades of life savings disappear in days, left with nothing. 20,000 employees lost their jobs. Thousands more lost their medical benefits and their futures. The architects of the fraud had lifeboats. The people who actually did the work were forced to stay with the sinking ship. During congressional hearings, the full scale of the deception was laid bare. The genius of the smartest guys was revealed as simple theft. This was a boardroom heist. Leadership used complex math to rob employees and the American public. Kenneth Lay and Jeffrey Skilling were eventually convicted for their roles in the collapse. The masterminds finally faced the consequences of their manufactured reality. The legacy of Enron is a warning about modern finance. The system often protects the top layer while leaving the foundation to crumble. At the highest levels of Wall Street, the rules are often treated as suggestions. Thousands of lives were destroyed so a few men could secure their next bonus.